And thank you everyone for joining us today for our Harmon Street Advisors tax tips, pitfalls, and strategies for landlords. This is going to be a recorded meeting, and it will be distributed afterwards and posted on the various socials. So if you're not able to make it through the whole meeting, please feel free to check it out later as well. But quick before we start, disclosures, of course. Always discuss your specific circumstances with a professional, whether it's Stephanie or Harmon Street Advisors. This is not specific tax advice. It should not be construed as that. It is great tax tips that you can take and hopefully utilize with your tax professional and financial professional. So just keep that in mind. A little bit about Harmon Street Advisors and myself. So my name is Dan Sherman. I am an enrolled agent. I actually worked with Stephanie previously. She encouraged me to get my enrolled agent certification. And I've also passed the certified financial planner exam and gone through a series of courses. I have a bachelor's degree in investment analysis. And I do offer, not through Harmon Street Advisors, but I can provide Medicare products as well for people who have questions. It's a great tie-in with financial planning that Harmon Street offers, as well as we do 401k plans for corporations, cash management, which we're going to talk a little bit about today, employee stock options. We really distinguish ourselves by looking at it holistically, utilizing a financial plan. And so we like to make sure that we understand everything that's going on with you specifically and really give you result-oriented goals so that we are helping you meet and achieve those goals, whether it be retirement, purchasing a home, or a investment property. And really, Harmon Street Advisors has a lot of clients that have investment properties. So that's why we chose to do this topic today, is simply it is very popular prior to these interest rates rising. And even with the interest rate rising, there's a lot of tempting opportunities to rent property. And that is absolutely part of your financial plan. And so we wanted to incorporate that into our learning series. And so we have a great guest speaker today. Her name is Stephanie Anderson. She's an enrolled agent. She is a certified tax planner. And she won the American Institute for Certified Tax Planners Preparer of the Year in 2021. She was also Best of Long Beach Press Telegram's accountant for 2022, although she is working on her CPA. It's still about, would you say, a year out or so, Stephanie? Give or take. But she never, regardless, won Best of Accountants. She's an incredible tax preparer and tax planner, and she's going to talk about that today. She has a lot of great services. So without further ado, let me go ahead and hand it over to Stephanie. Stephanie, thank you so much for joining us.
Oh, thank you, Dan. Thank you for that wonderful introduction. So what I'm going to do is share my screen and go over our tax tip presentation. Please give me a second from beginning.
And thank you guys. Thank you again for everyone who's just joined us. We really appreciate your support, and we hope you learn a lot today. So as she's preparing for this, Stephanie is located in Long Beach. She has an office in Long Beach, and she also has a secondary office, two offices, correct, Stephanie? One in Cambria and another one in Westlake
Village. Yes, Westlake Village. Long Beach, Cambria, and Westlake Village.
And of course, she's available by Zoom as well, anywhere in the country.
Yes, most people enjoy the Zoom these days because driving and all that.
Yes.
Okay, so if I start talking too much, somebody do timeout because I do get carried away. I love this stuff so much, and there's an abundance of information in tax, right? I mean, I spend at least 5 to 10 hours every single week reading and studying and keeping up to date. And pretty soon we're going to be absorbing the Inflation Reduction Act, which is going to have a lot of great opportunity for 2023. I cannot wait for it. But it is going to be pretty radical. A lot of people are going to have to reconsider things that they thought they had figured out already. So we've got that coming. All right, so the tax law is very complex, as you all know, very, very complex. Once you make one decision, it could potentially affect everything else, right? So you always want to take a good holistic view. Today, I'm going to make generalizations and simplifications. This is not specific tax advice for you as the viewer, because everything must be taken in by a case-by-case basis and have, specific documentation done on that particular taxpayer. We can't give tax advice on a general broad, blast. But what we want to do today is talk about proactive tax planning as the key to savings. And we're going to go over some very specific things that landlords may or may not be aware of as far as tax savings. Okay, proactive, right? So my first tax season was 1988, right? I was young, I was, taking accounting in college, and I happened to live a place next to a tax office, and they put up a big sign for tax season, and I did not realize how much I was going to love it. So what happens? The normal cycle is that people finish out the year. The financial reporting is rock solid, right? Those bank statements from their financial institutions are printed, they're recorded. And then you take all of your information to a tax office during filing season, right? Let's say January to April, right when anybody who works in a tax office is experiencing an incredible amount of overwhelm, overwork, and stress. And that's how America's been doing it forever. And at that moment, think about that during filing season. What kind of tax strategy can be implemented at that time? None. There's very little that can be done once the year is closed. So what we need is a new model. We need proactive tax planning that happens before the transaction is recorded. Plan it out, right? When we're not overwhelmed with deadlines and things like that. So we're talking about proactive here, which is smart, and it's really the key to building wealth. And people think of tax planning as risky, shady, illegal, right? There are of course, some bad actors in any industry. However, real tax planning actually lowers our audit risk, right? Because when you're implementing tax planning, there's certain things that are being done in the back end that the client may not know about. But like if I'm implementing tax strategy, I always consider if I'm going face-to-face with a IRS chief counsel that would question my position or my advice, right? That's really what it means to be a tax professional. So I've learned how to prepare for that and what I need to have, right? There's different tax confidence levels. Speaking and writing and working in tax confidence levels. That's what it is. And the better you are at that, and the more you do that, the lower your audit risk. It's a lot riskier to not do tax planning and to just let the year close and throw a bunch of information in a tax office when they're experiencing their most overwhelm. Tax planning is not illegal. We implement court-tested and IRS-approved strategies based on case law and the Internal Revenue Code, right? There's actually 400 tax strategies written into the tax code. If you took all of the pages, the first part of it, the smaller section, is about being in compliance. The rest of it is teaching us how to save money on tax. Honest to God. And as an enrolled agent, I'm held to the highest standards, right? An enrolled agent has a federal license. We're allowed to practice tax in all 50 states, and we've taken 3 proctored exams from the federal government. Tax planning is not for everyone. So if you're just earning a W-2, right, you're an employee, there's really very little that can be done. I mean, there are some exceptions, but they don't come up very often. In general, tax planning works best for people that own a business, real estate owners and investors. Oh my goodness, there is so much opportunity available for people that own rental real estate. And especially for those who are paying more than $25,000 in tax for high income earners. Yeah, if the only income stream is a W-2 and you're paying little in tax, very likely that tax planning engagement will not benefit you. Again, this is in general terms. It's not a quick question. Okay, so I cannot tell you how many quick questions that I receive on a daily basis. In fact, 2 days ago, I spent 12 hours trying to answer micro communications that I receive. That would be text messages, emails, phone calls, right? And people will call with a quick question, right? Should I lease or buy my vehicle? I would say that's the #1 question that I receive. And that, we have to unpack that, right? Like there's so much nitty gritty that can go into that. So there's really not a quick question. Everything affects affects another part of the financial plan. And tax planning is not projections, although this is the common belief that it's estimating the vouchers, estimating tax payments and providing vouchers. And trying to guess what next year's tax liability will be. And that's what some people use as the term as tax planning, but it really isn't that. All right, so the first thing you want to do is get to know your effective tax rate. There's tax brackets, marginal tax rates and all this, but the effective tax rate is really like the nitty gritty of what you actually paid. So you take the amount of tax and divide it by your taxable income. Okay, so let's say you have an effective tax rate of 20% once you've looked at your 1040. And if you need help with this, let me know. We can easily find the effective tax rate for you. You might even have it on like a summary sheet in last year's tax return. But let's say your effective tax rate is 20%. If we were able to find a deduction that you legally qualify for of $5,000, then you take the deduction that we found, multiply it by the effective tax rate, and now you have an actual tax savings of $1,000, right? So not everything that you qualify for is a dollar for dollar credit. So this is how you want to start thinking about tax planning. And there's about 400 tax strategies. Identifying about 5 that complement each other can create powerful results for a taxpayer. This is our ordinary earning and tax cycle. We earn money. We have money that comes in. And then we pay the, we do our tax return, we pay the amount owed, and then we spend what's left. This is what we're all taught and what's mostly happening out there. What about the tax smart earning cycle? We earn the money, we spend the money in tax smart ways, right? Proactively before the financial reporting is solid, and then we pay tax on what's left. So there's spending strategies and there's saving strategies, and I don't have a whole lot of time today to get into that, and I'm trying to rein it in, not too much. Okay. So first thing that's very specific for landlords, I cannot tell you how much I see of this. Fixing depreciation problems on Form 3115. Why would you want to do that? Because if you're going to dispose of a property, let's say you're going to sell one of your rentals, the worksheets that are required on a tax return to determine the taxable gain have a line on there that's called allowed or allowable. Meaning, if you, what was at that moment, the tax professional or the person using TurboTax has to figure out what was the correct depreciation that should have been taken on this property all of its time it was placed in service. That's the number that goes on that worksheet, not the number if it's wrong. So let's say you missed out on depreciation for 20 years and now you're going to sell the property. You're going to have to calculate gain on depreciation that you never got. And it's shocking how much I see of this, right? Because when a new prospect comes in or a new client comes in, we ask them to upload last year's tax return. And this is one of the things that I look for is depreciation errors. It's really, really, really important, right? So here are some of the common mistakes. Didn't use the right recovery period. Okay, I don't want to talk too much about that, but there might be an instance where some rentals qualify for the 39 year versus 27.5. That's a big deal. All right, didn't depreciate the property at all. Yeah, that happens. Or you depreciated the real estate without pulling out the land value, which is not subject to depreciation, right? Land doesn't depreciate. And you didn't adjust the basis of inherited property to its fair market value on the date of the death, right? So if you inherited property at the date of death, you get a step up in basis, which more likely than not helps you because it can reduce the gain, right? So this is a lot of stuff that's happening out there. Like so much, there's tons of it. Okay, so we have 2 planning tips for a 481A adjustment. We'll talk more about 481A in the next slide, and I won't bore you to death with it, but it's just something to be aware of. If you're going to have a large 481A adjustment, you might want to plan for that, right? That might be a year where you're going to take a windfall from another aspect of your life, where you can plan to have a 481A adjustment in the year where you're going to have extra income coming in, right? Maybe you're going to sell some stocks. Maybe you're going to sell a rental property. There might be an anomaly year where more income is coming in. And then, of course, I'm sure any savvy landlord out there knows about the cost segregation. You can do a cost segregation study to accelerate depreciation deductions for real property you placed in service in the prior year, and then use Form 3115 to claim that additional depreciation expense using a 481A adjustment. So cost segregation is its own other world, but basically in a rental real estate, the whole entire building gets depreciated at one recovery period. But if you had an engineering study done and you could take out smaller components that have a shorter class life, let's say of 5 to 7 years, then you could accelerate depreciation and get a larger loss on your Schedule E for that particular year. So what does it look like to actually do the work of Form 3115? Well, people like me love doing it. I enjoy it. You get to make a lot of spreadsheets, right? Do a lot of math, and then a whole separate packet, not with your tax return, but a separate packet is mailed out to an IRS service center where that's going to be reviewed by somebody. So you want this to be really, really high-end work. You don't want any problems with this. And this thing that you're looking at is the attachment, right? You just make this yourself. It doesn't come with any software program. This is the kind of substantiation that is required to take a 481A, right? And then here's what it looks like. It looks like a negative. Like this particular example, we found an additional $16,000 in missed depreciation that this client got to take in 1 year.
Nice.
You want to make sure that this is done before you dispose of a rental property. All right, I did that pretty quickly, I'd say, when that was a robust subject. I'm going to move on to another controversial topic, which is holding real estate in an S corporation. If you want to see a seething cauldron of debate occur amongst financial professionals, bring this topic up. Man, people really feel strongly about this. All I'm going to do is present one pro and one con. I'm not going to go deep into this because
I know there's a lot of articles. So.
Oh yeah, there's so much. In general, I'd say people are against it. But here's two little things to think about, right? If you get into one of those debates or if you want to consider it yourself, I just found two very interesting details. If you convert your current primary residence into a rental property, you could potentially miss out on the exclusion, the 121 exclusion, right? Well, most people know about the 121 exclusion. And you would have a lower depreciation basis with fewer tax deductions, right, as a result. And then there's my citations for that: private letter ruling and Internal Revenue Code 121.
So, and just a quick for our audience, the 121 that you're referring to is that $250,000 or $500,000 for your personal property.
Right, that is correct.
So yeah, but for rental properties, you probably wouldn't receive that, I would assume.
No.
Yeah. So.
No, but it's pretty common to see people have a primary residence and then level up, right, and turn their prior primary into a rental.
Yes.
Mm-hmm.
Sorry, I didn't mean
and
to.
They often do that without consulting anybody, without considering the tax ramifications, the long-term ramifications of that. So this is just one positive about moving it into an S corporation. And I want to present both sides of the story, right?
Yeah.
There is a negative. I mean, there's multiple negatives, but shoot, sorry about that. Oh my God.
This is the fun of doing Zoom. Thanks for everyone. Thank you.
Yeah.
Got it. All right.
Okay. So if you converted a C corporation to an S corporation, you want to be aware. Oh, see, the problem is I'm trying to move. Okay, be aware of this. If I touch the screen, I can't see it because the video is covering it, but if I touch the screen, I'm going to lose the slide again. So just be aware of, if you have a C Corp and you're moving it into an S corporation, that there is some non-favorable tax events, okay? If you want to talk more about this, please contact me outside of the Zoom. All right, the next topic was Schedule A itemized deductions. And we know with the Tax Cut and Jobs Act that Schedule A took some hits. It took some big hits.
Yes, it did.
Yeah, we got some big hits here. So I've got a couple of workarounds and tips to share with you today that I'm very excited about. Right. Most clients do not qualify to take medical expenses on Schedule A because it's reduced by 7.5% of your adjusted gross income, right? Potentially, there's a workaround for out-of-pocket medical through an HRA or HSA if you happen to qualify, right? Not everybody qualifies for that too, but it's just something to consider.
And an HSA, just for people who know, it's not Harmon Street Advisors. It's a health savings account. And it is actually a financial product that allows you to save. I believe it's $6,000 a year. It adjusts, so you have to check. But every year you take a high deductible health plan. So they're a great vehicle for a lot of people, including self-employed. If you have relatively good health and you're able to pay the deductibles are usually fairly high. So you're looking, it's not $6,000, it's usually $9,000 or $10,000 for your deductible, somewhere in that area. But yeah, it is a great vehicle. So yeah, so please, I just wanted to touch on that point.
Yeah, the HSA and HR is like, HRA is a whole topic in and of itself, and it's great. I always choose a high deductible plan so I can partake. SALT. This is where people in California and New York really took a punch to the gut. State and local income tax, that's what SALT stands for. And in California, people are paying definitely more than $10,000 a year in this area. And we can only deduct up to $10,000 on Schedule A. And so I see clients miss out on $20,000 to $30,000 worth of deductions in SALT, right? And so there is a SALT workaround that we're going to talk about today. And the other thing on Schedule A is that, the mortgage interest deduction, which is subject to limitations, gifts to charity. There are plenty of planning opportunities in this area. However, you just want to make sure that you have the proper documentation. And where are you storing that documentation? I recommend HubDoc. HubDoc is one of my favorite programs, and it's changing the face of audit. It's changing the face of audit because in audit, you need to sample. You don't have to look at every little thing, right? And you can sample. So if everything's in HubDoc, the auditor can sample in there, and they're never asking for a copy of the books and records. This is what's starting to occur out there.
Oh, wow. That's a great tip.
Yeah, no, it's power. I think HubDoc is like $12 a month. Imagine how much money that could save you under audit. I mean, I use HubDoc every single day. I love it. And then we have casualty and theft loss, which is a narrow allowance now. And then miscellaneous is even less.
Yes.
Okay. So what is a SALT workaround? If you have a pass-through entity in which you receive a K-1, and I'm going to talk about California because that's where I am. However, I put the link there for the AICPA has a map of the United States, and I believe it's 29 states now have adopted the SALT workaround. And then there is the link there for the Franchise Tax Board, their discussion on the PTE, the pass-through entity credit. So basically it works like this. If you have a certain pass-through entity, right, which means that the entity itself isn't paying its tax, is federal tax, that's passing through onto the 1040. That particular entity, all of the owners could choose to pay this elective tax. Why would you want to choose to pay an elective tax?
Right.
It sounds absurd, but when you really run it out, it can be beneficial for a lot of people that are losing money on Schedule A. So what happens is it pays this tax, and it has to be a certain amount. It's a very specific number. We don't get to determine the number. There's a law you have to follow, and you have to pay a very specific amount. But now you have reduced the taxable income on the federal level for that entity because state taxes are deductible. And then you have a credit that flows through to your California 540 income and reduces your state tax. So it can work out for a lot of clients. Last year, I had to spend a lot of time taking classes on this because it was a fast and furious changes that kept occurring as everybody was trying to figure out how this works. And then I had to analyze that for my clients. So there was a ton of time spent on this, but a lot of people benefited from it. Okay, and I realize PTE is a very long subject. Again, if you want to know more about your personal PTE opportunities, please contact me offline.
Yeah. And we're going to share that information as well, Stephanie. So, there's a lot of tax subjects you're talking about very, very quickly here. So just to remind everybody, we will be making that available to you. And you can also contact Harmon Street Advisors if you are unable to contact Tax Pros, and we will get you connected. So, because, okay, sorry, I just wanted to make sure, because that was a very, very light touch on a very deep subject. So I think a lot of people would be interested in.
Yeah, I'm under the impression that I need to be going quickly here, that I have about 20 minutes to handle these topics.
Yeah, no, absolutely. I appreciate, we're almost done, everybody. And we do appreciate patience. There will be a prize at the end of her, we're going to have a little poll as well. So if you guys stick around to the end, we're going to have a poll, and you can win $25 for Amazon. So we just have a few more slides, and
Yeah. And for landlords, I think this one is really, really important. Okay, so one of the topics was, how to maintain your records. We're actually required by law to keep contemporaneous books, records, and substantiation. That means that kept in real time. And that's something that HubDoc helps me do, right? So when I get an emailed receipt, or I get any type of transaction that occurs, I can easily put that in my HubDoc account by forwarding an email or snapping a photo with the app or whatever. And I'm keeping records in real time. No more of this receipts in a shoebox situation. That's a complete and utter waste of everyone's time. And there's thermal receipts now. Those receipts fade. By the time you go for audit, you may have a shoebox full of white paper with no proof whatsoever. Pro tip, you can iron them and you'll be able to see them. But is that how you want to spend your day? That's not how I want to spend my day. I didn't go
trouble just ironing my clothes.
Yeah, I'm not going to iron a bunch of old receipts. No, I'm going to have HubDoc. I'm going to have share file, HubDoc, tax down, something, right? And our mileage logs must be kept contemporaneously. And there's a ton of programs out there. Mile IQ was the most popular one when I wrote this slide. Okay. It's important to issue 1099s as a landlord. And if you read this, if you go reading online about issuing 1099s as a landlord, you're going to see a lot of information that doesn't agree. You're going to see a lot of disagreement out there. However, I want to make one point. If you're trying to take section 199A, meaning that your rental rises to the level of a trade or business under section 162, and so that you qualify for an additional 20% on qualified business income under section 199A, one of the ways you can help meet that test is by issuing 1099s to your plumbers, to everybody, all of your vendors. It's a pain in the butt, I know, but it can be worth it for you. My favorite software to keep track of my rentals is Stessa. I like collecting rent in there and keeping track of the fair market value and things like that. And they actually are providing a pretty good interest rate through their bank account system. And I just want to encourage you to pay for a professional bookkeeping service when it comes to handling your rental properties. The IRS wins 86% of their audits. Why is that?
Bad bookkeeping.
Why are they winning? Because people don't do this. They don't have these things done on this slide.
And it is a lot of work. I mean, to maintain your books, it is a lot easier to hand it over to someone like yourself that can handle bookkeeping and do all the work for us. But if you just have one property, at least you have something like Stessa available. You just got to take a little time at the end of each month, right? Or
yeah, I mean, if people were going to do anything, I would say HubDoc, where you're keeping track of the invoices and the receipts. That's $12 a month, and you can create a bunch of automations through your email.
Sure.
It's really easy. But yeah, so that's why it's not that people want to cheat on their taxes. Well, at least my clients or the people that I work with, 99% of them want to do the right thing and are being honest. I mean, people are so terrified. I mean, I'd say this, this is one of the core fears. So why is IRS winning so many audits if people are being honest? Because they don't have what it takes paperwork wise to win. If you just bring a bank statement and it says Home Depot, you're going to be disallowed that deduction because you need the Home Depot receipt. Where is that Home Depot receipt? In your pants pocket, on the hot, the desk when you walk in, you throw your keys. Where is that?
Next to my iron.
Things like that. Okay, I'm going to stop talking about this. and phantom income, right? I mean, I get in Schedule E information. Here's the income, here's the expenses. I look at it and oftentimes I just know in my gut, I can tell that they actually probably spent more money and they just don't have a record of it. They don't remember, right? So this is the other thing that a good, keeping good records can do for you is reduce your tax liability just by having that information. So how are we doing on time? Because this next subject is robust.
Yeah, so we're getting close to the hour. You know, maybe let's see, how many more slides do you have, Stephanie? I apologize.
Just a few.
Okay, well, let's go ahead and go through them, and we appreciate you know, the folks who are Joanna, Christopher, Michael. Thank you all, and also my friends that are joining us as well. Thank you all for sticking around. We are going to continue to go, but we do want to have a question and answer at the end. So if you guys will allot us a little bit more time, we'll probably go for another like 20 or 30 minutes, and then we'll be done. You can move on to the rest of your afternoon this beautiful Saturday. So so anyways, go ahead and grab the last couple slides, and then we'll do a quiz, and we'll be done.
Okay. So one of the topics requested was how to invest in improvements for a deduction. Not all repairs and renovations can be written off in the year you incur the expense. We must practice discernment between an expense and something that goes to a capital account and expensed over time according to the class life and depreciation method. And you can review some of this in IRS publication 523, which doesn't sound fun to other people, I'm sure. But you know, we practice discernment and make sure that these things, and most things are qualified under a capital account, meaning, you know, that you can't take, even though you spent that full amount of money in that tax year, you don't get to take the full expense, and it gets depreciated over time. So there's a lot of nitty gritty, and again, a perfect example of having good books and records of how easier this will be able to handle at tax time.
I think there's also a lot of people miss the difference between amortization and depreciation on those. Some items do need to be amortized as well. So
yes, that is correct.
So yeah. All right, landmarks.
Yeah.
Fun topic.
So how to invest in improvements for an deduction? This is a workaround. Historical landmarks are, in my opinion, just a tax haven.
Yeah.
There is so much. I put all the citations at the bottom of the screen. You can see how much has been written about this. And then I also put some links there about different government websites that are written, they're easier to read, written for the person that doesn't want to read tax law, right, on how to do it. But there are certain scenarios where we can get as much as 70%, you know, when you talk about the federal and state. And this was just funded. There is money here. So
yeah,
what is it? Go ahead.
Oh yeah, no, this is a great topic, and actually you'd be surprised, there was a Norms that was just recently a historical landmark. There's a lot of great properties that you wouldn't think about it as a historical landmark, but could actually be designated that way, and it's great to observe those properties, and it's great to live in them as well. So you know, they work great both ways. But anyways, please continue. I didn't.
Oh yeah, there's plenty in Long Beach too.
Yeah.
You know, there's a lot of great, I mean, you know, in the 20s in Long Beach, this was one of the most affluent areas. And there's just some beautiful properties around here that qualify for historical landmark. And there's so much I want to say. There's so much I want to say, you know, personal experience and things like that around this. But I do own one, and I've gotten the history done on the building and things like that. And it's just so incredible. And to know that your property can never be torn down, right? It's there. we're really preserving something. And there's certain periods of time when construction was done a certain way, right? Where it's just rock solid, beautiful, things like that. So you might want to consider if any of your properties would qualify for this, right? You hire a service, I think it's $1,950 the last time I checked, to have somebody do the work. Then you apply with the city. And then, if you're going to be renovating apartments anyway, or renovating homes anyway, you might as well get something that can accelerate that deduction. Okay, and then real estate professional designation. Some of you may be aware that if you show a loss on Schedule E, you may not be able to take that loss, right? Because of the passive activity limitations. Yep. And most of my clients are subject to the PAL limitations, right? So even if we did like a cost segregation or a 3115 481A adjustment, we may not be able to take that, and it just gets suspended and carried over and carried over. And if you're hopping around from tax office to tax office, that carryover could fall through the cracks, right? Who's going to delicately make sure that your carryovers are properly reported year after year after year? Because if you're switching tax offices in the middle of tax season, somebody's going to enter all that old data from your previous return correctly into the new tax software, and to make sure that that doesn't get lost, right? I see it so much. So how do you overcome the PAL limitations? Well, one way would be to qualify as a real estate professional. And that doesn't mean getting your real estate license. It means how you spend your time, right? You must spend 750 hours a year in the real estate trade, and you must keep a contemporaneous log of those hours, right? So my clients that qualify for real estate professional, they keep a paper log. They go buy a day planner or whatever at Staples, and they write in it all year long. Then they put that in a FedEx envelope and send it to the tax office. And I don't open it. That is locked away in a filing cabinet, and I would only open it in front of an auditor to prove that we kept a contemporaneous log of our time.
That's awesome. I'll tell you, a lot of people, including one of my brothers, they all want that designation, and you tell them that they have to put in all these hours, and they go, "Oh, it's too much work. That's not going to work for me." So, but it is very much possible to do, as Stephanie's pointing out here. So, but it just takes a little extra effort, and someone like Stephanie is a perfect example of someone that can help you maintain that designation and really make sure that if you do come to an audit, that you're going to be able to prove it. Would you say that people who take this designation are more likely to be audited?
Well,
just a general guess.
There's a lot that I look for on a tax return that I know the supercomputer's looking for before I check that box. Right. Because let's say they have a W-2 job. Let's say they report a W-2 and they report real estate professional. Right. Boom.
Yeah, exactly. That's a really easy way to trigger a red flag. And so by following these contemporaneous log of hours and sealing it, as Stephanie's recommending, that's a huge tip right there. A lot of people probably haven't thought about that. But again, if you guys really want to make sure you're doing it right, work with someone like Stephanie. Don't try and do this all yourself. It's a much, much easier road to hoe with a partner. So, But yeah, so is that, do we have, I think we have one or two more slides.
Well, I just wanted to, say if you want a free tax discovery session, we can review last year's tax return and look for missed opportunities, credits, and deductions. And then I just have my case study, Dan, that was on somebody else, but sure. We don't have to go over.
Okay, well, we can go over it real briefly if you'd like, just to kind of, now this is not someone who's a landlord, but someone who owns a business. Happens to be a marketing service firm, correct?
Yes, I didn't have time to write up a real estate case study, but I already had this case study and people loved this one. And it brings up an example of spending strategy versus saving strategy. Okay, so this was a client who was paying for professional bookkeeping and CPA services. He had a bookkeeping firm and a CPA firm. And he saw one of my videos on YouTube and contacted me. But so he, every single year when he finished his taxes, he owed $10,000 and was on a payment plan for $800 a month. And then he came and did a tax discovery session with me. And even though this guy was already a great client, already paying for professional services, I still found a way to change his life. And what I did was I started by creating an exceptional bookkeeping and record keeping system, HubDoc, Zero. Let's get it done. And we do that work for him. Then we have I had monthly meetings with him for 8 months in a row, where we started going over all of his transactions and discussing them, the month prior transactions. Then I changed the entity type in which he was holding his marketing firm. Then I changed how he paid for health insurance, his office rent, and his car. And I changed the salary he was taking. So this particular client, this is an example of a savings strategy. He's not spending any more money. He's spending his money in tax smart ways. He would still be buying health insurance, paying office rent, paying for a car, paying himself. He would still be doing that. But I changed it in a way that was more beneficial to the client. And his last tax return, he actually had a refund of $932, which got applied to his back tax liability. And then I got on the horn and I changed his payment plan down to $200 a month. So this client is cash flowing in a whole nother world, and he'll never go anywhere else. He's so happy.
Yeah,
He's so
I would
happy.
be too. And this is a really good example of how, having someone that really understands the tax code can be beneficial, because a lot of people are like, I can just do this myself on QuickBooks, right? Even he's going to a CPA, but in this case, the CPA itself is not a tax professional. Whereas Stephanie, as an enrolled agent and soon to be a CPA, really understands the tax code in addition to accounting, right? So yeah, I mean, do you have anything to add there? I know.
No, that was all. That was it. I got through. I did it all.
Okay. Well, Stephanie, thank you so much. I'm going to go ahead. We do have a quick poll, but before I do that, I'm just going to share really quickly on the financial planning side. For financial advisors, we do have a few things that we offer as well. And I'm not going to talk too much because of the limitation on time, but it is important to remember that your financial advisor has access to portfolio lending. So, if you need to borrow additional funds in order to pay for a new property, maybe you're looking for a bridge loan or something like that, you can actually use your assets, whether it's cash, stocks, bonds, treasuries, things like that. You can, in the case of treasuries, you can actually borrow up to 90% of the value of the treasury. And it's not as likely for treasury to get a margin call because it doesn't fluctuate as much. There's also fixed rate vehicles that are out there, and even mortgages, where one of the really nice benefits is when you're doing a collateralized loan and a portfolio lending, you don't have to go through the underwriting process that is involved with a mortgage. And so that could be a huge benefit if you're a property owner and you're trying to make a quick upgrade to a property. You've got some things that you need to fix. You need to add new water heaters, new roofs, things like that. And then the beauty is you can actually take a deduction against your income, including rent, which is considered income as well for an investment. So, of course, you got to be careful. There is margin calls. Sometimes the rates can be higher. Also, in some instances, depending on how much you're borrowing, some of the loans, the minimum is $75,000, and they go upwards of hundreds of thousands of dollars, and they can have very competitive rates to mortgage rates even. So it's a great area to look at, but sometimes, depending on the loan, it does vary, and there's a lot of different loans. So just keep that in mind. There's also diversification, which is really important to keep in mind. Real estate is an incredible asset, and you can use your down payment and leverage that and get a great return. However, we've just dealt with COVID, and we've experienced what it's like when people stop paying their rent. And so it's important whether you're trying to diversify between types of real estate assets. Perhaps it's, you want to own some industrial real estate or even a farm or something of that nature. And then there's mitigated risk through non-correlated assets, which a lot of people really don't think about, but brokers can offer oil and oil exploration partnerships where that is no correlation really to real estate. They can offer commoditized commodities. A lot of times that is oil, but there is other commodity related assets available, public and in some cases private, including farmland. And then there's bonds, and there's some other private loans, and there's private real estate transactions we're going to talk about in a second. But it is important to remember that bonds are loans, and they are publicly traded most of the time. There is private notes as well. We're not going to talk about that today. And you can actually take bonds and have it not, you're going to get paid that interest rate, whether it's a treasury or a corporate bond or a municipal bond or an agency bond. You're going to get that interest rate, and then depending on the risk of the loan, you're going to get that money back at the end. So it's nice to have a non-correlated asset in addition to your real estate, and it doesn't have to be stocks. Stocks are great as well, though. And then the last thing to remember is that a lot of landlords have cash that they are holding for high liquidity events, whether it's needing a new roof or a new water heater, or perhaps you're just holding on to that in case you need to pay the mortgage when there's nobody renting on that property. So there is incredible rates right now on treasuries. You can get 4.6, 4.7% on a 1 year. There's 6 years. There's, you can get it at any distance. There's CDs out there. Your traditional bank account at home is probably not going to get that 2.5% interest rate, or 4.5. Excuse me. Maybe you're getting 2.5 at best on a lot of savings accounts, and a lot of them are paying way worse than that right now. So talk to your broker about using cash management. They can give you some great opportunities to make a lot more interest than you would normally. And just to keep in mind, we always have to disclose. Sometimes you have to be an accredited investor for some of those non-correlated assets. There is reinvestment risk where you have that money coming back to you, and now you need to reinvest it, and it could be at a lower rate. It can have a liquidity trap where you are in that asset for a very long period of time before you're able to take a draw. So there's a lot to remember. And then, of course, there's also systematic risk and unsystematic risk, which is we don't control the war in China. We don't control inflation. You may also not be able to control the management of the investment that you've made. So that's a unsystematic risk. If you have a specific investment and you're a limited partner, you don't get to do the day-to-day decisions. So just keep that in mind. But the last thing is estate planning. So it's important to remember, and a lot of people have a living trust, and that's great if you do. But there's a lot of types of trusts, and you do need to consult a lawyer. A financial planner is there to kind of be your guide, and we understand a lot of the trust and the dynamics of the trust. But choosing which type of trust is important, and we can help with that. But we're not lawyers. But the trust itself helps you to avoid probate. It transfers out the property to your heirs, and it gives the other option is that you can give property to charity right now, or you can give it to your beneficiary right now through an irrevocable trust. And when that occurs, you have a step up in value now. Rather than waiting for the property to appreciate, which is great, especially if you have a long period. Giving it to it now sometimes can be a huge tax advantage for the people receiving the property, because you're getting that immediate step up, and then they receive the benefits of the investment property into perpetuity, and you get a 50% reduction in your taxes when you do charity. So there's a lot to that.
It can also reduce your estate tax by keeping it out of the estate. But again, these are very technical trusts, and there's a lot to it. And lastly, it does provide control to who's going to receive it. It makes sure that you're going to have the right person receive it, and that there's not going to be a fight in that probate. So again, just be aware there's paperwork and costs involved. It can increase your insurance costs if you're doing like a charitable trust and it's no longer in your hands. That can increase the cost of insurance. The step up basis within the trust, it's important to remember when that occurs and how that occurs and what the benefits are to that. And lastly, it's very important to remember, in a charitable trust, in an irrevocable trust, you are giving away your property. That is no longer in your control. So just keep those in mind, but those are great topics as well. And, at Harmon Street Advisors, we do offer a lot of great information. But, regardless of who your brokerages are, make sure you are consulting with an advisor. It really is beneficial. So thank you all so much for joining. I really appreciate it. We're going to go ahead and do a quick poll. Just one question for those who are still on. The first person to answer it, we're going to email you a gift certificate for $25. So let's go ahead and launch it. Hopefully you still remember. Stephanie, is that poll up now? Can you see it?
Yes, I can see it.
Oh, good. So, somebody got it.
Oh,
we got
boy.
all right. So somebody, we got one tax pro. That was a trick question. So,
Oh, man. I see the results coming in.
all right. Well, this is good for marketing too. We're learning a bit. But Tax Pros is Stephanie's company. So we want to thank her very, very much. And the person who got that correct will receive a gift certificate. We're going to go ahead and end that poll. And let me stop sharing real quick. If you want to reach any of us, this is the information for Harmon Street Advisors. You can find us on our website at harmonstreet.com. And in addition, this is Stephanie's contact information, and she is at Tax Pros with an SE at the end. And with that, let's go ahead and open it up for questions. If you want to type them in the chat box, that's fine. We'll go ahead and unmute everybody. Sheila, if you could unmute. Sheila is another administrator here in our office, and she's amazing.
If I want to invest in properties in other states, do you guys do that, or is it just California, or?
Is that question for me or for Dan?
Whoever can answer it. I don't know.
So
I was just curious if you guys, if you guys handle like the state taxes for other states, or if it's just.
Yeah, well, that's a great question, Michael. The economic presence in other states is a delicate topic. As an enrolled agent, I have a license that I can work in all 50 states. And I do have clients all over the United States with rental portfolios. So yes, feel free.
Okay, awesome.
all right. Does anyone else have any questions? Otherwise, we'll go. Thank you guys very much for coming.
Well, hold on, Dan. There were a couple of questions that came through in the chat during the presentation. There was a really actually very interesting question about if someone's retiring and they've got currently passive income from rental properties. Is there any advantage to, okay, I'm retired now, obtaining a real estate license and turning that into, I guess, active income?
That's for Stephanie.
Yeah, I mean, the exciting thing about retirement is that now your time is opened up, right? So we're all allotted 2,080 hours a year to allocate our working time. And so there's so much of the tax law that is driven by a time log. Okay, so now that you've retired from a W-2 job, if your main activity can be that that 750 hours in the real estate trade, then what you've done is opened up a way to take losses on Schedule E. And that really has nothing to do with a real estate license. It has to do with how you spend your time. So you would need a pretty robust, real estate portfolio in order to do that.
Thank you. Another question that came through is, how much does the, how much does Stessa and HubDoc cost?
HubDoc is $12 a month. I'm not aware that I use Stessa and I'm not paying them anything.
Yeah, that's the perfect price.
So yeah, I mean, there's different levels you can buy of any software program, right? But I mean, it's all very inexpensive when you consider the opportunity cost of not being prepared for an audit.
Yes, and the time cost certainly. Is replacing a water heater considered an improvement? If you're replacing an old one with a new one, is that considered an improvement?
A water heater, that's on my slide. Let me bring it up.
And while she's bringing that up, Christopher Weary, you are the winner of the prize. Just thank you very much.
All right, Christopher.
Thank you.
Hi, Chris.
Hi, how you doing?
Wow, great. Okay. Oh.
Yeah, my question was the water heater one. I was just wondering if the old one's broken or close to dying and you buy a new one, I'd have thought that would be deductible, but maybe not. Maybe.
I'm going to bring up the slide. I'm just struggling with it, okay, with the PowerPoint and everything.
Well, and while she's bringing that up, yeah, I mean, so the water heater is depreciable time, or it may amortize. That's a Stephanie question. That's one I have to double check on. But once the value is diminished completely, and you put a new one in, you can redepreciate the new one, is my understanding.
Yeah, that's an improvement.
Okay.
Yeah, that's definitely on the slide.
Okay, I didn't know that. Thanks.
How much was that water heater?
Well, I've done it a bunch of times, but I think they range from about 1,000 to sort of 2,000. Yeah. During COVID, it was a lot more.
Yeah. Oh
Yeah.
man. Yeah, that was a nightmare. And it's still to today. Christopher, are you here in Southern California, or where are you located?
Yeah, San Diego. Yep.
Oh, okay. Yeah. Getting labor to come out is like pulling tooth and nails. It is so hard to get a plumber, especially a good one. So yeah. I know I've experienced that as well. Did you have any other questions?
There was another question that came through on the chat. If we inherit a rental property, how do we handle the depreciation on that?
Oh, I love that question. Well, it depends. It depends, right? Was there a trust? Was the property held in a trust?
That was not specified in the chat.
Yeah.
So maybe take us through both. It was held individually and held in a trust.
Okay. Well, this is what I know from my experience. When you inherit a property, it depends on the type of entity that property is being held in, the type of trust. So you first have to start with that understanding. But ultimately, at the date of death, I highly recommend getting a professional real estate appraisal, because you want to immediately record your step up in basis, right? And then at that point, you have to take the step up in basis and subtract the building and the land. You have to allocate those numbers. So those are two things right off the bat that most people screw up on. I'll just be honest with you. So get an appraisal, figure out what the new fair market value is, and then allocate a certain amount to land, right? And then that's ultimately going to end up on your Schedule E.
All right.
Thank you. So it sounds like someone can continue to depreciate if they've inherited it.
Yes.
Okay.
Depending on the type of trust, which I don't have that information at this time, but at least we know enough to know which questions to ask when we start unpacking the problem, right?
Yeah.
Yes. Thank you.
All right, Jeff, any other questions?
There was one more. If we don't issue a 1099, do we still have to, or can we still deduct a payment to a person?
Okay, that's a good question. On a Schedule E for a landlord, I would say yes. But just know that could be challenged, right? If you legitimately spent the money. Notoriously in tax history, landlords are not issuing 1099s. And that's why I brought up section 199A and qualifying for QBI, proving that it rises to the level of trade or business under section 162 is what we need to mark yes or no on in order to take section 199A. So it's in your best interest to do that. However, most people aren't doing it and are still taking the deduction. Okay. And I just know from personal experience of dealing with plumbers and certain companies, they're very reluctant to fill out that W-9 and give you their TIN number. So can you still issue a 1099 if you don't have the recipient's tax identification number? Absolutely, you can. 100% you can issue it if you don't have that TIN number. So programs like Xero, which is an accounting software program, they make it easy to keep track of issuing 1099s for vendors. I hope that answered the question.
Thank you. All right, that's all we had in the chat.
Great. Thank you very much again, Stephanie. And thank you for those of you who are left here. And have a great weekend, everybody. And,
Thank you.
We'll talk soon. Take care.